Picture this. A humble metal that hasn't topped its all-time high in over 4 decades suddenly explodes past it, sparking echoes of legendary market battles and hinting at a wild modern-day squeeze. It's not just hype, it's silver's dramatic resurgence that's got traders buzzing and investors on edge. But here's where it gets controversial. Could history really be repeating itself? Or is this just another fleeting frenzy? Let me break it down for you in simple terms. On Tuesday, the silver market hit a milestone that will likely be etched in financial lore. Spot prices surged above the $53.40 per ounce mark, finally breaching the 1980 peak set during the infamous Hunt Brothers scheme to dominate the market. This breakthrough wasn't random. It came on the heels of skyrocketing physical demand, tight supplies, and a growing liquidity crisis right in the heart of London, the epicenter of global silver trading. To put it plainly, people and industries are clamoring for more silver than what's readily available, and the system is straining under the pressure. And this is the part most people miss, the underlying forces driving this. Silver's ascent has been fueled by a mix of safe haven buying. Think investors flocking to precious metals during uncertain times, falling interest rates that make borrowing cheaper, and bets on booming industrial needs, like solar panels and electronic gadgets, where demand is outpacing what producers can supply. For beginners, imagine safe haven flows as people parking their money in silver, because it's seen as a hedge against economic turmoil. Much like gold. Declining rates. They encourage more speculative investing, since holding assets becomes less costly. Now, let's dive into the drama unfolding in London, where the liquidity crunch is turning everyday trading into a high-stakes puzzle. The London Bullion Market, once the deepest and most reliable hub for precious metals, is grappling with severe shortages. Lease rates for short-term silver loans have skyrocketed, over 30%, a record high, making it extremely pricey for traders to keep their short positions. That's when you bet on prices falling and borrow metal to sell. This has flipped the script, forcing traders to get creative with logistics. For instance, with London prices commanding a premium of up to $3 per ounce over New York. Some traders reportedly flew silver across the Atlantic by cargo plane just to exploit the price difference. A real-life arbitrage play. While that gap has narrowed to about $1.75 now, it highlights the deep-seated stresses in the market's infrastructure. To clarify for newcomers, arbitrage is basically profiting from price differences in different locations, like buying low in one spot and selling high elsewhere. Experts from Goldman Sachs point out that silver's smaller market size, about 1/9 that of gold, means even small shifts can cause huge swings. Without big buyers like central banks stepping in to calm things, a minor dip in investor interest could lead to wild volatility. Think of it as a small boat rocking harder in a storm compared to a huge ship. The parallels to the Hunt Brothers saga from 1980 are striking. Yet today's scenario feels eerily familiar with a modern twist. Back then, brothers Nelson and William Hunt, wealthy oil tycoons, piled on leverage and futures contracts to hoard nearly a third of the world's available silver, driving prices up to around $50 an ounce. But when regulators clamped down on borrowing rules, the bubble burst spectacularly, crashing prices below $11 in just months. A classic tale of greed and overreach. Fast forward to now, and while we're not dealing with one big conspiracy, the market's fragility is similar. A swarm of diverse players, individual investors, ETFs, exchange-traded funds that track metals, and automated trading bots, all piling into momentum trades. The common threads? Heavy reliance on borrowed money, leverage, scarce supplies, and funding pressures that make it tough to sustain positions. Federal Reserve interest rate cuts, combined with government spending deficits, and a renewed appetite for safe assets have set the stage for silver to shine brighter than its peers. ETFs are bulking up their silver holdings, and industrial buyers are scrambling for stock amid near record low inventories in London's storage vaults. This surge isn't isolated. The whole precious metals arena is benefiting from the same economic tides. Gold, platinum, and palladium have all jumped 55% to 82% this year, as investors shield themselves from inflation fears, political instability, and worries about America's fiscal health. But silver has outperformed them all, evolving from a side player into a key gauge of liquidity woes. Analysts suggest this reflects both hot investor demand and ongoing supply shortfalls, a viewpoint backed by Bank of America's upgraded 2026 price prediction, bumping it from $44 to $65 per ounce. Yet, policy moves are adding extra heat to this already volatile mix. Traders are anxiously awaiting outcomes from the US government's Section 232 probe into critical minerals, including silver, platinum, and palladium. Rumors of potential tariffs or export restrictions have stirred geopolitical anxieties, potentially limiting supplies and driving prices higher. Couple that with the leverage and shortages we've discussed, and silver's become a powder keg of uncertainty. If central banks like the Bank of Japan or the Fed tweak monetary policies and stir up global liquidity, we could see even more turbulence ahead. So, is this the unfinished business of the Hunt brothers, or just a fleeting echo? That's the big question. If physical shortages linger and central banks stay hands-off, silver might keep its upward trajectory into 2025. But if speculative bets unravel suddenly, the fallout could be just as monumental as 1980. One thing's for sure, silver is back in the spotlight, not as a dusty footnote from history, but as a vibrant indicator of financial pressures. 45 years after the Hunt's epic downfall, their legacy might be inspiring a new wave of traders to push boundaries again. Here's the controversial angle. Some argue this rally is a bubble waiting to pop, fueled by hype rather than real value, much like the speculative frenzy that doomed the Hunts. Others see it as a smart bet on inevitable supply crunches in green tech and tech industries. What do you think? Is silver poised for lasting glory, or is this another cautionary tale in the making? Share your views in the comments. Do you agree with the bubble theory, or do you side with the supply deficit believers? Let's discuss.